Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, January 21st, 2023. It's great having you with me here today, and we got existing home sales. They fell. Nothing too exciting about that. They did fall less than expected, coming in right about 4 million units. And that's on a SAR, that's an annualized basis. That's actually the lowest reading we've seen since 2010. So no doubt, very challenging times to sell a house today. Why is that? Prices are up, mortgage rates are up, and affordability is really being questioned out there. We can see it inside the data. The West fell 45% year over year, and that's 10 points above what the national average was. However, if we look at houses over $1 million in the West, we see a fall of 55% year over year. So clearly, yes, a challenge. Inventory is going the wrong way also. So we saw inventory drop under 1 million units. We usually see 1.4. It had kind of lingered over the last several months at 1.2. People are pulling houses out of the market. They're waiting for better times to come. That will probably hurt in terms of transactions levels, and will keep people who maybe thought that as the prices started to move backwards, we would see some rekindlance of demand. However, sellers are not going to participate at this moment. They've moved out and they're waiting their ground at this point. What's price doing? Price is coming down. We see price moving down to under 370,000. And remember, we had kind of peaked. We had been moving towards 400,000 on an average transaction. Days in the market is falling, but still, what really is kind of interesting is roughly 55% of houses are being sold inside the first month. So there is an opportunity out there to sell if you price it right, and that transaction can go off smoothly. If not, people are waiting. And I think that's what we're finding, is that if you miss that first initial correct price, you price it a little high, you have a tendency to sit for a period of time. Where is this moving us? We are seeing lower mortgage rates. We continue to see a solid housing market, and we're still seeing a strong demand for housing. Supply is being constrained on the new side and the existing side. So getting back to a normal market may be a long time away. Hopefully, as lumber comes down, hopefully, as incentives are put out there, and we're seeing them. We're seeing lower financing offering by new developers. So maybe this will be the start of something that will actually start getting transactions going at a more rapid rate. Until then, it's sort of a perplexing situation. It would be helpful, as the economy is looking for weakness, that we'd get a nice rebuild of the residential investment in this country. Not there yet. So struggling housing market, got better news from the international environment in terms of retail sales out of Canada, a little bit better in trade out of Germany. And so there are signs, especially internationally, that things are starting to move forward, unless you look at the UK, which is quite challenging. Maybe this export demand can be something that can help the US economy as we move forward. But it's clearly looking at higher interest rates as the Fed meets at the end of this month, and they're still focused on inflation. Another not helpful sign for the housing market. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.